with computer audio, and then I'll mute.
Okay, can you hear me?
Yeah, this is Danny.
Hey, Danny.
Hey, Danny.
Hey, I need to see if
Jay, Julissa.
Can someone resend the link for the webinar to me? Because it's not working when I click on the calendar invite.
Hey, Julissa, I'm only dialing in from my phone today.
Yeah, I just saw your text. Thanks, Jay.
Oh, okay. Danny, did you say you can't access the web version?
No, I clicked on the link in the invite, and it takes me to an error message.
That is weird. Let me see if I can access that.
Danny, I just emailed you the link.
Okay.
Message content scroll area. On the table. To enter this table, vertical square. Message table. For message conversation collapse. Display triangle. Markup in messages table. System connection. Complete message conversation. Complete message conversation collapse.
This meeting ID does not exist. Please re-enter your meeting ID followed by pound. Enter participant ID followed by pound. Otherwise, just press pound to continue. You are in the meeting now. There are 11 participants in the meeting. This meeting is being recorded.
Woo woo.
You are muted. You are unmuted yourself by pressing.
Hello, everyone. It'll be just another minute.
Okay. So
Jack, would you like me to get started?
yes, Lisa, why don't you go ahead and introduce the process and we'll get going.
Okay. Welcome, everyone, and good afternoon.
Good afternoon. This is Tanisha Washington, BCT Partners.
Hi, Tanisha. My name is Jaleesa Cully, and I'm from the Institute for Community Inclusion. And welcome to today's Community of Practice meeting. The topic for today's meeting is assistive technology lending. Before we get started, I would like to give you a few tips on how to use the Zoom platform. In order to minimize audio feedback, we will mute everyone except the presenters. We would like to make the discussion as interactive as possible. At each subtopic presentation, there will be some time afterwards with an opportunity for a discussion related to that topic. So if you would like to chime into that discussion, please feel free to unmute yourself at that time and chime in via the audio. If you have any issues with the connectivity to the audio via your computer, the phone number to call in is listed in the chat box. There is also an option to raise your hand using the Zoom platform. So if at any time the presenter is speaking and you would like an opportunity to speak later in the conversation, you can raise your hand and we can do that. In addition, there is a chat box. If you are not connected to the audio or would just prefer to type in your questions or comments instead of posing them verbally, please feel free to do so. Questions that are relevant to the discussion at hand will be addressed during that part of the presentation. We are also setting aside 15 to 20 minutes at the end of the call to address other questions. If you look in the chat box, the link to the closed captioning is posted there as well. If you have any other questions regarding Zoom, please feel free to type it into the chat box, and I will do my best to try to resolve the issue. And without further ado, Jack, go ahead.
Okay, thanks, Julissa. And thanks, everybody, for joining us today. We're going to talk about assistive technology lending. And let's see, if you pull the agenda up, you'll see the order that we are mostly going to proceed. I think the first two items are going to be relatively quick discussions. I think we'll put those out with our experts and then give an opportunity for discussion. The third bullet on loan policies, and then I think the sixth bullet on best practices, I think we'll take those together in a row because I think they fit better, and we've got some subsequent slides to show you during that. So let's get started with the
Jack,
first
this is
item.
Tanisha. I'm sorry I joined late. Did you already introduce BCT and the team?
We have not, other than Julissa's going through the protocol. Did you want to go ahead and?
Sorry. Yeah, I'm sorry. I was having a little bit of difficulty connecting. This is Tanisha Washington with BCT Partners. I am the Deputy Program Manager on the Access for All training. I just wanted to take a moment on behalf of BCT to invite to welcome everyone to the call. We appreciate the time that you're taking out of your schedule to participate in this training. It is the second phase of the Access for All training that we are doing in conjunction with the Department of Treasury. The first training having been in-person training locations in various locations, and then now we're doing the community of practice discussions that you're participating in, and the third phase being direct technical assistance. We are joined by my colleague, Jack Brummel, who's speaking right now, and other subject matter experts who are delivering the training. So I'll turn the microphone back over to Jack, but again, thank you for your time.
Thanks, Tanisha. And then when we sent out the agenda, we gave a list of the team members that are going to be taking part. And on the first issue, and actually the second issue, these are relatively short points, but Susan, you wanted to talk about and then we'll have Danny address this as well, helping lending staff understand what AT is. So Susan, go ahead.
Thank you. Can you hear me okay?
Yes.
Okay. So some of you who attended the in-person trainings will have a good overview already about what is assistive technology, otherwise known as AT. But without going into the very long definition from the federal government, assistive technology can be capsulized simply by saying it is any device or service that helps a person with a disability, including seniors, do the things that they want to do. So it is broader than the medical model of technology, which often under Medicare rules are devices such as wheelchairs, scooters, but it is broader to include anything that can help you do what it is you want to do. So it's defined by you, the individual, as opposed to a system. So it would mean an adapted vehicle. So the lowered floor ramp and tie downs that can help a wheelchair user travel safely around. It can include a home modification, so ramps or widened doorways, lower kitchen counters, smart home devices that can help, you know, by using your voice or pushing a button, turning on lights, having your refrigerator talk at you about what's in the refrigerator and what's a menu. It can include air mattresses on your bed, a specialized bed, so that if you have MS or a spinal cord injury and you can't move independently, you've got air flowing around so it prevents you from getting bed sores, to even an iBot Roomba, which can help clean your floor. So again, to best understand it, it's looking at any device, whether it's generic, meaning just off the shelf, or specialized, customized, that helps you do that you need to do. Danny, from your experience, are there some, certainly some of the sensory things like hearing aids, eyeglasses also fall into assistive technology. But Danny, any other suggestions?
Well, I just want to, not to restate what's already been said, but just to kind of reinforce, one of the reasons that definition is so broad is a protection for the people with disabilities. You don't have to worry about something qualifying or being disqualified as assistive technology. And I think if there is confusion about, what may qualify, touching base with your Independent Living Center, your Assistive Technology Act program, they can kind of help provide some of that feedback, maybe some trainings as well, just to kind of expand your perception of what does and doesn't count. But I think your point of, it's anything that increases your independence is assistive technology. Smartphones are our number one. It's my number one piece of assistive technology. It's got the screen reader built into it, object identification. I can read things, zoom in from a distance, do color overlays. A mobile phone can take the place of several individual pieces of technology. But it's not one of those things that, somebody may not look at a cell phone and automatically think that's assistive technology. Same thing with a tablet, a computer, a smart speaker has a lot of integrations where you can do lights and thermostats and door locks and all kinds of things so that you can control something with your voice or with an app on your phone. So that's, that's the wonderful world of assistive technology, is sometimes thinking outside the box and being a little bit creative when it comes to finding those solutions.
Yeah. Thanks,
Danny,
Susan and Dan. Go ahead.
Well, that's really helpful. It brought up one other issue of thinking outside the box. We have several people who are members of our staffs and close partners who have children who have autism. And two items that frequently come our way are fences, so that, families can get together and their children can roam freely and safely, and also weighted blankets. So I think that Danny's point of looking at who you are and trying to figure out what it is you want to do is a good guide.
Thanks, Susan and Danny. And I think the reason we phrased this particular topic the way we did is that lending staff may have some confusion, and it'll be incumbent on you in working with them to help them understand that the broadest definition is the one that focuses on what the client needs and what the person with disability says will improve their functionality. I'm going to go right into the direct lending versus partnership, and then we'll pause for questions after that. Danny, your program does direct lending, is that correct?
We do. So we have a history of doing both. When our program started, it was a partnership. It was a guaranteed loan program. And then we found that it was better for us in our particular state to do direct lending. And we were able to do that through some buy-in from some local organizations and from the states. And then I believe they got some federal funds. They started this well before I started. But we found that being able to have that direct connection with the consumer was important because it allowed us a little more flexibility with working with them to determine what was going to work well for them and how we could finance it.
And then we're going to distinguish this from partnership loans in a second, but I wanted to let David talk as well. David, your program is a relatively new one, and you are a large organization. Do you want to talk about your you're doing direct lending as well, are you not?
Correct, we are. So I'm David Beck, and I'm with the Center for Community Self-Help in North Carolina, which is a CDFI that includes 2 credit unions and a loan fund that are all CDFIs. And so we run this program out of the Self-Help Credit Union in North Carolina, focusing on North Carolina through our branches in North Carolina. And we are at this point a full service credit union. So we do very small loans, signature loans as they call them, up to our largest loan was $40 million for real estate development. And we have, at this point, 170,000 credit union members nationwide and about 77,000 in North Carolina. So we began our assistive technology financing program when we learned that North Carolina didn't have any such financing program in existence, and that there were also federal grant funds that might help us start it up. And so I think my understanding is we're fairly unique in the AT financing world in that we came to it as a lender more broadly, and then have added assistive technology financing to our loan offerings. And we do this in close partnership with the North Carolina Assistive Technology Program, the state organization that helps people with persons with disabilities find the appropriate device for their disability. So our loan, originally we didn't get the first round of granting, and we started doing loans assistive technology. We started marketing assistive technology loans at our just normal interest rate, which varies broadly depending on what the loan is for and what the credit worthiness of the borrower is. But when we got the federal financing grant in 2017, then we decided to use that funding to help create a fund where we make all assistive technology loans across the board at 4% interest rate, whether it's a hearing aid or a vehicle modification or a home upfit or what have you, and expanded our underwriting standards and contracted with the NCAT program to help compensate them for their referral work and expertise. And we did that because we wanted to make it easy for borrowers and also easier for our staff to understand the availability of this loan product and understand that it was at a discounted rate. And so I don't know if that that helps, Jack. I'm glad to go further.
Yeah, no, thank you. So the direct, Danny's program, David's program does direct lending. The Northwest Access Fund, I think they're on the line. And then I think Natalie out of Oklahoma has some direct lending. But I think Natalie may have started off with guaranteed loans. And Susan, your program was historically guaranteed loans as well. And now you have some direct lending. Do you want to talk about that?
Sure. So we have actually 3 loan products. We first started off with partnership loans, which means we were working as first an alternative financing program and then a CDFI. And this holds true today as a CDFI. We work with 3 larger banks that they've got the loan capital and we just don't have enough loan capital. So we have a contract with 3 banks so that if someone is, and we'll talk about credit worthiness in a little bit, but we can use their capital and it's actually technically their loan, but it's our underwriting standards and for assistive technology, which they don't traditionally extend loans for. But that allows them to also get some CRA credit because the bulk, like with CDFIs, the bulk of our borrowers are low income. So one of our banks is a very large regional multi-state program, and this helps them. One is regional, and one is even smaller than much of a region. It's more of a small community bank. But we're using their loan capital, and in the last year, it was a little over $2 million of their money. If someone has and then we buy down all of those loans, 1%, one time only, of the principal, so that those banks will do several things. One is not market to these borrowers so that there is no, quote, deeper relationship. We don't want credit cards going out to these people or other products until they pay off the loan. And secondly, we want there to be no fees. So no closing costs, origination fees, document fees, early payoff fees, no fees whatsoever. And then thirdly, we want to keep the interest rate low. So it's 3.75 for the life of the loan. So that 1%. So if people hear the concept of interest buy down, that's what it means. And so all of those partnership loans, and then we have within that category two. One traditional where we're not having to back it. We've just done the underwriting and, it's for assistive technology, and the bulk of those loans are unsecured. But then some people, about a third of our loans, they fall outside of any type of traditional credit worthiness, including having no credit or very thin credit. And we will back those loans dollar for dollar or 50 cents on the dollar. And we can talk more about that, but then we also have the direct lending. But I think, Jack, more than $2 million of our dollars are partnership loans.
Yeah, good. And so that the point of discussing this is to let people know that there are different models out there, different ways of getting loans out the door to help people get the assistive technology they need, and that we are happy to explore the different models with people that are interested in turning to assistive technology lending. Let's pause here for discussion and questions. There may be others on the call, as I mentioned earlier, that have experience doing AT lending. If they have anything to add to the discussion that hasn't been raised already, that would be great. And then also any questions that any participants have about just what we've said so far about, understanding, making sure the lending staff understand what AT is so that they're not unnecessarily restricting people from getting the loan they need, or, the difference between direct lending and partnership loans. Does anybody have anything to add? Emerson from Northwest Access. I'm sorry, was there someone?
Yeah, this is David Beck. I actually have a question for Susan, if no one else has questions.
Go ahead.
Sure.
Susan, I'm curious why. So you're partnering with 3 different banks on your partnership loans, and I'm just curious how come you just didn't end up going with one, or how that developed?
That's a good question. We decided to go for 3 for a couple of reasons. One is we didn't want to be vulnerable in case one of the banks, our original bank, which is the very large regional one, Santander, if they wanted to pull out, that would leave us in a pretty vulnerable position. And the second reason we went with several others is that we've developed relationships within our community, and people who have disabilities we're senior members of the management, and they sought out us, and they would agree to the same deal of 3.75 plus the partnership, and plus the low interest rate, and so it gives us options for getting money out quickly through our door. So I don't know if we were not a CDFI, we would not have access to much capital at all. But being a CDFI and then having these other banks come to us helps them with their reviews with both the OCC and the FDIC.
Okay, thank you. And I just want to note, I see that Adrian is on the call with Credit Union out of El Paso. And so, Adrian, David has a model of AT lending, and this is an issue for you that you were interested in. You should, we're happy to connect you with David to learn more about how his credit union has done this work. We're going to move on now. I see that I don't see any.
Hi, Jack. This is Emerson.
Yes.
Sorry for not speaking earlier. I had two mutes on, and I only undid one. For us, we sought out a bank partnership when we first started out. We're exclusively a direct lender. Our founder and first executive director, Francis Pinnell, had gone out to multiple banks within our region to try to seek out a similar partnership as to what's in Pennsylvania, and we were unsuccessful. So we moved forward with being a direct lender. And so from my end, I think there might come a point where we would want to seek those type of partnerships out again in the future, kind of speaking to what Susan was saying about capital constraints with being a direct lender. And I'm curious if folks have recently developed those kind of partnerships and if banks are still willing to engage in those partnerships given the changes, potential changes in the CRA or just a different climate around banking than there was when maybe Pennsylvania was founded.
Okay. Thank you. I see from Anna, but Anna, I'm just looking for your, you're working on an EQ2 agreement now, Anna, but that's related to, more related to capitalization, right, rather than their securing or than your guaranteeing a loan that they make.
Jack?
Anna is, yes, go ahead.
I was going to say, if I'm understanding Emerson's question correctly, it was about the willingness of banks to partner in this environment, the way they are with Susan.
Yes.
And
yes.
Just maybe it's instructive, a little history, but well before we were involved in this, there was a nonprofit in Charlotte that had a relationship with Bank of America, and or I think it was still Nations Bank at that point. And anyway, that partnership dissolved when Bank of America and Nations Bank merged because Bank of America decided they needed uniform products across all their markets, and this was not going to meet that qualification. So a little bit like Susan said, if having multiple partnerships makes sense for that reason, and I wouldn't expect this as a big enough item to really drive their CRA requirements, whatever those may be. I would think it's more on personal relationships. But I also would, not to be biased towards credit unions, but I think maybe that's another angle to think about. If you can get credit union partners with broad field of membership, then you can sort of serve people that way, and the odds are that credit union's not going to change dramatically at any or get bought out, and so that'll be a stable partnership.
Good. Okay.
David, this is Susan, and you brought up an extremely good point, and we tried to work with credit unions and went through the Pennsylvania Credit Union Foundation, and it is finding that a credit union with a broad membership so that we could have the breadth across Pennsylvania that we needed. And it's also true that it is around relationships, but instead of getting EQ2 agreements, the way we're accessing capital is through those partnerships. And one bank is a fairly new bank, and it was solidified when one of their senior vice presidents, their daughter has ALS and needed to buy an adapted vehicle, and knew about our program, and it worked so well for them in terms of making those connections around vehicle modifications, a vendor, and being able to process this quickly without all of the red tape that some of the banks are having with adapted vehicles. I mean, we're not alone. Adapted vehicles are not easy for many banks to finance. And, you know, our programs know how to do it. And we were able to do it quickly because of this partnership.
Good. Okay, thanks. That's been a good discussion. Let's move on now to loan policies. This is a big topic. We may need to spend a bit of time into that. And we are going to, as I mentioned at the start, we are going to also talk about the best practices in the application and review process. And we're going to look at a document that Susan has provided that they use in making decisions around lending. So let's start on the loan policies. Susan, let's start with you, and then we'll invite Danny and David in, and then we'll move to some discussion. So go ahead, Susan.
This is Tracy Beck. I work with
Oh,
Susan.
Tracy, thank you.
Sure, Jack. She asked me to step in for a few minutes and just talk about our processes and policies. And I was just making some notes here. You know, what we do is a very narrow niche of funding assistive technology, but I think maybe more importantly, or most importantly, besides the funding piece, all of our staff here is very well educated on what other alternative funding is out there for assistive technology and how that would work for a potential borrower. So we stay up on the regulations for Medicaid, Medicare, vocational rehabilitation, and other grant funding sources so that we are able to educate people who contact us or people who submit applications so that they are getting the most robust and accurate information that they can so that they can make an informed decision. And, you know, we're not saying you need to go to another funding source instead of taking out a loan, but we just want to make sure that people have all of the information necessary. And so I would say, in addition to doing our loan products, information and assistance is probably one of the most important things that we do here at PATF. We have two loan products, or three loan products actually. Susan mentioned we have our mini loan program. We're the direct lender for up to $2,000. We are registered by the Department of Banking to extend those loans. And we have a small loan committee internally that reviews those loan applications. For our larger loans, low interest, we go up to $60,000 at 3.75%. And then the third loan product is our guarantee. And if we have to guarantee the loan to assure the bank that it is safe for them to lend out their money, we can guarantee loans up to $35,000. And all of those, and both of those low interest products are at 3.75%. And both the mini loan, the 0% loan, and the 3.75% loan are no fees. So there are no other fees associated with these applications. So, you know, if someone needs their credit pulled, we are not charging a fee for that. And part of that is philosophical. So with our mini loan product, 0%, 90% of the people who take advantage of that program are receiving supplemental security income, which is less than $800 a month. And we know that if we charge them $25, $20 for a credit report, that could be one loan payment. And really, frankly, many people just can't afford that extra cost associated with processing applications. So that's why we do fundraising, and we absorb all of those costs.
Tracy, this
yes.
is Jack. I'm looking at the screen in front of me, and I'm noticing on the loan amount, it's $30,000 loan, and I'm looking at the term, and those are 2 points where your the program I was associated with, the Northwest Access Fund, we may have different, for our loan terms, I think our longest loan was 5 years. However, I think now for home mods, it may have gone up. Can you talk about your loan term? That's a 10-year loan, right?
Sure, and that is the maximum loan term. So for home modification, we will, depending on what the person can afford, because we do take that into consideration as well, we will go out 10 years. And for home modifications that are more than $10,000, that is treated as a home equity loan. So the bank in that case would take second position, and in this case, if this person's loan was actually guaranteed by our board of directors, and I'll explain a little bit about this form, but the bank, our largest bank in this case, did take second position on his mortgage. And the only other product where we place a lien are modified vehicles. So everything else, all of our other loan products are unsecured loans. And
are they mostly below that? You've got a $30,000 loan here, but do you otherwise have a lower loan cap?
No, well, our loan cap goes up to $60,000, and I can tell you that most adapted vehicles are even more than $60,000. We just met with a dealership last week, and they are quite expensive, along with the modification to the vehicle. So back to my first point, that's why it's really important to know about other funding sources, so that we can package these loans and applicants are getting the most bang for their buck. So we think it's really important to know about those other funding sources. Otherwise, you know, last year, for example, we had a woman who was going through the local vocational rehabilitation office. She had a disability. She had a full-time job. Her vehicle was $125,000. So essentially, you know, it's a computer with 4 tires. She took out a loan with us for $60,000, and the Office of Vocational Rehabilitation paid for the balance. So it takes quite some time. In that case, that particular case, it took 9 months, and she had to reapply 3 different times. Because as many of you know, banks won't hold on to an application and keep it open after a certain period of time. So that is very extenuating. That's often not what happens, but I just wanted to bring that up. But real quickly, this credit summary, if our low interest loans need the guarantee, we have 16 board members who convene to look at the loan. Our board members are spread throughout the state, and if you've never been to Pennsylvania, it's quite large. I live in tiny little Delaware, and you know, Pennsylvania is quite a large state. So what we have done is come up with an online forum where we post these credit summaries, And the forum is a safe place that only our board and staff have access to. People can post comments, the board members can post questions, we can get back to them quickly. And really, after years of trying to come up with information that is helpful for our board members, the information that's included in this credit summary is what the board requests. And, you know, we have all the numbers, we have the debt to income, how much the loan would cost. But most importantly,
do you want to talk about the debt to income a little bit? Because that was the issue for the bank. And I know that a lot of AT loan programs have a policy around debt to income ratio that's probably different from most banks' policies.
Sure. So if, in the case of our banks, if anything is more than 50% DTI, they will not extend a loan. They will not consider extending a loan. So in this particular case for John, his debt to income was nearly 57%. So even though he had good credit, his debt to income was just a tad over. And in the next section where there is a narrative, that's where we can explain John's background, his situation, why he needs the AT. And if we need to, we can include you know, information about credit. If somebody has poor credit, we could talk about that. Yeah, could you go to the next slide, please? So this is where we talk about open trade lines, closed trade lines. In many cases, there are delinquent trade lines, and in this case, there are none. But I just wanted to give an example of debt to income and somebody who can actually afford to pay their monthly bills. So in this case, our board decided to guarantee this and back the guarantee or make the guarantee so that the loan would, or the bank would extend the $30,000. So even though someone, you know, on paper, it looks like this person may not be able to afford the loan, but because we talk extensively many times to our borrowers and applicants, we get a really good sense of how they're handling their monthly bills. And this credit summary is a great way to, it's a great snapshot to the person's financial ability to pay back a loan.
Good.
And then finally on the last page, you have monthly payments and income and their credit scores.
Yeah,
you can
good.
His credit scores are exquisite.
Yeah, yeah, this is a good client. So I want to turn to Danny and see, Danny, on loan policies, how does your program, what are some differences that that come to mind between what we've just heard Tracy talking about and how your program runs its loan program?
Yes, so for our program, we're a much smaller program. We do much smaller loans. So for us, we fluctuated over the years. When the program started, we did do some of the higher dollar things, like vans. That was the primary focus. And ours, like I mentioned before, we started out as a guarantee program, and we worked with 3 credit unions. To do our program, we chose 3 because it was consumer choice. They could choose one that was closer to them or one that they preferred. Yeah, so moving forward, when we kind of restructured and went to direct lending, we created a loan cap of $5,000. The reason being, a lot of the things that were being requested that weren't vans were generally in that 5,000 and under range. So We did that for a few years. We got some funding and were able to raise the loan cap. What had happened was when I first started working for the program about 5 years ago, we had a lot of requests for home modification. That was one of our biggest things. Aside from vans, which people are always in need of, home modifications came in a very close second. And so we were looking at some of the requests that were coming through in the work. One of the things that we require for our application process is a quote of the equipment or the work that needs to be done. And so we were like, well, you know, a lot of these, they're 10,000 and less. We're looking at, you know, adding a ramp, widening a doorway, doing some minor modifications. So when we got some funding, some grants, we were able to raise that threshold temporarily for those kinds of requests. But you do see we try to keep the interest rate low. Our interest rate is between 3 to 8%, and that's based on the credit score of the applicant. That is something that was decided by our board of directors for the Center for Financial Independence and Innovation.
So you have variation in your rate based on your assessment of risk.
We do. We have two types of loans that we do. One has a fixed rate, and the other it's based on credit score.
Okay, and that's distinct from Susan's, and I think that's distinct from a number of other alternative financing programs that fund assistive technology. So go on.
Absolutely, yeah. So again, that was a decision made by the board. We're always looking, looking and reviewing and seeing what's working. And we may actually be looking at revising that policy soon, just based on my experience and what I've seen as far as what people are qualifying for. For that, we're not really seeing a lot of the higher interest. Most of our folks qualify for 5% or less for the terms. Now, the terms of the loan, we can go up to 8 years, but it's based on the life of the device. So the way our program works is, so we, Credit Able is a joint effort between the Assistive Technology Act program, Tools for Life, that's who employs me, and then the Center for Financial Independence and Innovation, which is our nonprofit partner. So there's a lot that a lot that goes into the policy-making decisions for that. And I just lost my train of thought as I was staring at the screen there. Goodness, I'm sorry. I just had a
so you were going through you were talking about the terms of the loan and how it's set by the board. So
the reason I started
you
talking
also
about our AT program. So the term, when we look at the life of that device, that's where the AT program really comes in, because we work with the individuals to look at, how long is that, computer going to last? What is the expected, life of a sip and puff device or a home modification? So we review that with them. We help them explore what technologies are out there. And then when they start applying for the loan, that's when we start looking at, okay, what can we set this at? It's based on what they can afford, but it's also based, we don't want somebody paying, for 5 years on a phone that is going to be obsolete well before they finish paying for it, or paying for anything that just isn't going to last that long. A color identifier is not going to last 8 years. We don't want somebody paying too long for that. So that's where I think we work really well with our program, is helping to educate the consumer about that equipment and then helping set the terms that are going to fit that individual's budget.
Okay.
So when we look at things like home modifications, that's when we're stretching it out a little bit, because a ramp is gonna last. Now the other type of loan that we offer is it's meant more for credit repair and credit building. So that one, everything is set for that. It's maximum of 2 years for the terms. It is a maximum of $1,000, and it is a 4% interest rate. And that's really meant for folks that have acquired a disability and maybe their credit has become damaged, or maybe they've never had the opportunity to establish a credit score. So that's kind of there to help them start off on the right foot or to get back on the right track, as it were.
Okay, good. Thanks. I do want to turn to David. First, I just want to mention, Jaleesa, we have made available the loan policies of the Northwest Access Fund, and I'm pretty sure that Danny and Susan would make their loan policies available as well. How will people be able to access those if they're interested in looking at assistive technology loan policies?
So I have uploaded them to the chat box. So you will actually see around 3:12, I uploaded that document, and then you just have to click on it and it'll have a little pop-up and you can download. If for some reason you're having technical difficulties with that, you can send me a private chat or an open chat with your email, and then I'm happy to also email it to you.
Okay. And we're not recommending that people take a lot of time on that during this call, but just know that you will be able to access those. And David, let's talk about how would you describe your loan policies as distinguished from, say, Susan's program or Danny's program?
I would say more flexible, and essentially that's because the way we have and not that those are inflexible, but I think we still want people to have some confidence they can pay back the loan. But the way we have set it up is we're essentially using the federal grant money as what's known as a share secured loan. So the grant is deposited in self-help credit union, and the deposits are called shares in credit union parlance. So, and we use that deposit against the loans that the qualifying assistive technology loans that we make. So if a loan goes bad, we take that money out of the deposit to pay for our loss. And so that allows us essentially complete security in the event the loans go bad. And the concept that we're trying to prove is that the share secured, and as the other loans pay off, that money goes back into that share secured fund. And so our bet essentially, and we're playing with grant money, is that folks will pay back their loans and we can revolve it into more loans at a rate much greater than we'll take losses. So the fund can continue growing and be available for future borrowers. And this is a model that we've used in other areas, but this is one of the more this is certainly the first time I've been so intimately involved with it, and I think honestly it's a great model for credit unions and others to help leverage grant money in a way that gives you a lot more, gives the grantor at least the possibility of stretching the grant even further.
Good. Okay.
And that's also why we were able to just go to 4% across the board on our loans, whether it's regardless of the type or the credit worthiness of the borrower. So I think for us, frankly, and this maybe doesn't fit right under loan policies, but for us, one of the biggest challenges, just given the relative size of our organization, is making sure all our loan officers and everyone are understand that this special product is available for people who come in with assistive technologies. Because one of our challenges, we have a lot of different loan products, and it's not always we're not always perfect about making sure our borrowers will that our loan officers know what all is available for all the different types of borrowers. So there's a constant education process going on. But in terms of problem loans, we have the deposit to pay for loans that go bad.
Okay. Thanks, David. I'm going to open it up now. We've spent quite a bit of time on this, and you'll notice that we did sort of combine that loan policy bullet with a sixth bullet about best practices, where we've talked about credit scores, and we've talked about how taking the useful life of the device into account can help determine how long to make the loan for, et cetera. So let's open it up. Our other participants on the call that may have some experience with AT lending or that have questions about how they might proceed here. Let's see what we've got. Anybody?
Hey, Jeff, this is Emerson. I think for us, one of the biggest differences with our underwriting is that we require everybody to fill out a budget. And so we ask folks kind of what their general spending is in multiple different categories, which is something that our board and our loan officer has preferred in our underwriting decisions.
Mm-hmm. Okay. Good. And then I'm noticing Natalie from Oklahoma, you've got an assistive technology loan program. Is there anything about your program that would be notable or of value to other people that are thinking about doing AT lending?
Well, we're similar to Emerson in that we do look at a budget as well, so that we can not only analyze the debt to income, but look at the overall capacity to repay. And I stepped out for just a minute. You might have already talked about this in terms of if they have medical collections, we disregard that. We don't take that into account on their credit.
Good point. I think that's common, isn't it, for assistive technology lenders to disregard medical debt?
Yes, in Pennsylvania. And the other thing is that in terms of things that are unique, you can have had a bankruptcy. All we ask is that you be cleared from discharge by 1 year.
Good. Okay, and then I think Shaban with Capital Good Fund, you have expressed a strong interest in making assistive technology loans. Is there anything before we move off the topic of loan policies and best practices? Are there any questions that you've got related to this?
Yeah, so unfortunately I wasn't able to get that list of questions that I'd mentioned to you earlier when we spoke. And I had some trouble joining, so I may have missed some of this. But I think the biggest thing that we're looking at is this is a vastly different product from what we do, even though we are consumer lenders. So just trying to figure out how would we assess what the market is for this in our state? And what is the market like for, other AT lenders? How much demand are you seeing for this product? Because we would have to develop a completely new product line. So we're trying to evaluate that.
Right. Okay. And I know Susan will be working with you on this, but Susan, do you want to give a real quick call? Real quick response to that, and then we'll need to move on because we've got only about a half hour left.
Surely. There's a huge market because you've got the society has changed and more people with disabilities and seniors want to live in the community and be active in the community. So you've got a market with vendors such as hearing aid vendors, smart home device vendors, wheelchair scooter vendors, as well as a lot of individuals with disabilities who are really working at figuring out what's going to make their life possible in the community. So whether it's a home modification, an adapted vehicle, there are federal agencies that also are charged by the federal government and given money by the federal government to help support certain activities, but not all activities. So what I think Danny and David talked about, and certainly Tracy did, was the vocation rehabilitation agency, which all states have, will pay for some things, but not all. So they will pay for adaptations to the vehicle, but not the chassis, which is the body of the vehicle. And so I think the market is huge. It's I think, something that CDFIs who are not used to working so discreetly in one lane, so to speak, just needs to know how to get that word out.
Right. So one question that our CEO was really interested in was kind of like if anybody would be willing to share their outstanding portfolio size.
So you're curious about the 18 lenders that are on the call, how big their portfolio is?
Yeah.
Okay.
I'm happy to share that, Jeff.
My CEO is interested.
Well, maybe we can follow up on that, because it's like, what information do you want, are you looking for? Because some of this, just like all the other CDFIs, there's so much information we cannot give out.
Right.
So maybe we can talk offline about what is it that your CEO is seeking.
Yeah, just the value, just a number. But we can talk offline.
Yeah, okay. Let's talk offline on that one, and know that there are other, if you're interested in sort of getting a survey, we could probably facilitate getting information from others as well. Okay, I want to, thanks for that. That's been a good discussion. I want to move, the next three topics I think will not take us as long. But the first of these is participation of people with disabilities in setting policies and making loans. And we've got Susan, Danny, and David all have experience in getting people with disabilities. And I've got Susan down as going first. Briefly,
Okay,
Susan, do you want to address that?
Sure. So we were founded as a consumer-controlled organization. And in the disability lingo, that means that the majority of people, and we defined consumer, that means the majority of people on our board of directors are people with disabilities or immediate family members. And by immediate, we even have a definition of that, and that is someone who is involved in the day-to-day of someone with a disability. So oftentimes a parent or a spouse. And in some cases, even we've had siblings who've lived together and one sibling has a significant disability. So the board sets the policies, and that's pretty critical because some organizations have loan application committees, and they're approving or not approving, so approving or denying applications, but it really comes down to what are the guidelines for those loans, so that, you know, we have very flexible lending standards, and what we will look at, like a zero credit score, is in many cases just fine with us. And the reason that is then in our policies is because we know, and certainly our board knows, that many people with disabilities are unemployed, underemployed, and if you don't have much money, you're not buying things, which then means you don't have a credit score, or you don't have access to credit, like a credit card, and you're not repaying it regularly. So the board sets these overall policies, then we as staff carry them out, or we have a subcommittee of our board that's part of our applications committee before it goes to the entire board. Mm-hmm. But in any case, the board is setting the direction. We know we're talking to the community. It's a cross disability board. So, and that one reason that happened very early on is we had an application for someone who wanted to build an in-ground swimming pool. They had MS, they lived in the Poconos, and another board member said, who happens to be in the financial field, said they can just drive to their local YMCA. By the way, that was 65 miles away. So that taught us that we need people of varying experiences so that they can talk to each other, educate themselves, and we can be more responsive to the needs of individuals with disabilities, because again, we're consumer directed and consumer choice.
Mm-hmm. Good point, Susan. David, I'm going to turn to you next because you were a CDFI before you started making AT loans, and we've got a lot of similarities to folks on the call that are CDFIs that are wanting to look at this. What's your practice in getting people with disabilities to participate in your policies and loan making?
Yeah, that's that honestly is a challenge for us, given the size of our organization and complexity of our organization. I think it's mitigated by the fact that we have very generous underwriting standards, given the and history and experience as a CDFI. Getting down in the weeds with people to figure out our ability to make a loan or not. And with the grant money and the share secured model, we're able to be very flexible. But the development historically of the programs, when we got interested by a staffer who had a friend who actually sold assistive technology devices and noted there was no program in North Carolina. And so as we learned more, we thought it could be a good fit, and so we created an advisory board to help us think through what all we didn't know, which was a lot, and about serving the disability community, how to do it, where to try and get traction and get the word out, and use that information from the advisory board to sort of get us up to speed. But the main partner has certainly been the North Carolina Assistive Technology Program. That I contacted the director very early on when I learned that there had been a program in Charlotte previously, and she just gave me the entire lowdown and has been a great partner ever since in terms of helping us figure out who needs loans, who doesn't need loans. The last thing we want to do is give loans to folks who can find grant money somewhere else. And helping people sort of get vetted, I guess, for lack of a better word, with someone who might have a better understanding of what devices they actually need versus what they maybe have heard they need, has been important to us. And another really important partner has been the Disability Rights North Carolina, a nonprofit that mainly focuses on policy and legal issues facing the disability community. And so they have a lot of outreach as well and can help us think about how we as a lender can most effectively serve the disability community.
Thanks, David. You're reinforcing some points that were made at the last Community of Practice call about the reaching out to statewide organizations that serve people with disabilities. And Danny, I want to wrap up this quickly with comments that you might have about the importance of participation of people with disabilities.
Yeah, that is, I think that is of the utmost importance. We have a similar structure for our boards as Susan. You know, we have to have 51%. Ours is 51% people with disabilities. And that's also for the Advisory Council for Tools for Life. But having a person with a disability in a decision-making process is important. It's important for building trust with the community. So yeah, I mean, you said quick, that's quick.
Okay. Thank you.
Yeah.
So the key point, I think, for folks that haven't been making assistive technology loans is the importance of turning to the disability community, and whether it's possible to put people with disabilities on your board, which we of course would advocate, or of setting up an advisory group. We think the key is making sure that you've got the engagement of people in the disability community in helping you think through both your policies and ultimately your loans. The next thing, before we open this up, I'm going to go to the next one, and then we'll have a general discussion and then close with the final topic. We also have the notion of loan committees versus board of directors and decision making on loans and loan policies. And here, I'm going to speak briefly in the Northwest Access Funds, and Emerson, you can chime in here on this as well. The loan decisions are made for the most part by the loan committee, and it's only the exceptional loan that's outside of the general guidelines that would go to the board of directors. The board of directors is majority, like Susan and Danny's boards, is majority people with disabilities or their families. The loan committee also has representation from the disability community on it as the actual decisions are being made on the loans. And Emerson, I don't know if you have anything to add to that before we turn to the other.
No, that did a good job of getting a synopsis. Our loan review committee meets twice a month, and we have discretion internally as a staff for all loans under $1,500, and then the loan review committee takes it for the rest.
Mm-hmm. And then, Susan, I think in your organization, it's your full board of directors that's making decision on loans, correct?
No, well, it's almost correct. Internally, we have a committee for the mini loans for 100 to 2,000. And then we have a subcommittee of our board of directors for anything under 3,000. So there's only 4 people there, so it can happen very quickly. And then the full board votes on only those loans that require the guarantee, that they've already been turned down by another bank. And we do that online, so it's forever ongoing. And we actually keep debating on whether we should expand the loan review committee, but I think it got reaffirmed that because this is a fiscal decision on whether to, match the guarantee, that it's the board of directors and not a committee, because that board is it's the financial arm of and the group that has the financial responsibility. Mm-hmm. And I would point out that because we are large in terms of the alternative financing program, not large compared to David and self-help, but large for us. So we've got almost 41 million out there in loans. It does kick in additional reviews. So we have had like an OCC review, and that is a subject that's brought up of who is looking at those loans and making those fiscal decisions for the organization. Uh-huh.
So the size of your CDFI might be a factor that you would consider when you're trying to make a decision about whether you should make the bulk of your decisions through loan committee or through the board of directors.
Yes.
Okay, Danny, what's your practice?
Sorry. Oh, am I in meeting?
You just got off.
We hear you.
Oh, sorry, my screen reader is being a little funky, so I couldn't tell. So for us, decisions are made by it's a small committee. Primarily, it's the administrative assistant for the Center for Financial Independence and Innovation and myself. We review the applications, and then if anything is just kind of outside of the norm, that's when we can get feedback from the CFII, the Center for Financial Independence and Innovations Board, because they are the people that have the financial responsibility for the program. So for the most part, the two of us, since our maximum is $5,000, we're given pretty broad discretion to make the decisions. But yeah, if something just doesn't look quite right, or if we're kind of stumped on something, and that's happened like twice since I've been with the program, that's when the board gets involved. But we do report out to both the CFII board and the Tools for Life Advisory Council on loan decisions, numbers, and all that good stuff.
So people get the information, but the decision making is a smaller group. And then David, how does it work with your CDFI?
Basically, these loans fall within our individual underwriter within the parameters that we can approve without going to a board or a loan committee. There could be a situation where that changes, but we haven't hit it yet. It would have to be because of the size of the loan. But the share secured model essentially allows us to put the decision making with the underwriter in a very responsible way. And just to follow up on one thing Susan said, they are much bigger in the assistive technology lending world, the financing world, than we are. So we may be, we don't have anything close to $41 million in the volume on assistive technology lending, financing. So we're a big CDFI, a small assistive technology lender.
Okay. Okay, I want to wrap that up. And I think what I'll do is just go on to the next topic. You've got a variety there. So you've got the individual loan officer basically making decisions. You've got loan committees making decisions. You've got board of directors. So there's a lot to choose from. Those of you who are considering establishing an assistive technology loan program, there are a lot of models out there and you could probably come up with one and talk to us about how it's done under our programs. The last one is just briefly before we go to opening it up for questions across all topics, is consider starting an IDA program. So match savings, the Northwest Access Fund, and Emerson, you can chime in here because I know there's been some changes since I left the organization, but historically, I think about half of the applicants for loans at the Northwest Access Fund were turned down. And then the question becomes, well, these people really need assistive technology. What else can we do to help? And so we had offered a match savings program that allowed people to save when they really didn't have the capacity to pay a loan back. We allowed them to save, and we would match the savings, and with the assurance that those savings, since it's in a custodial account, if they're collecting benefits, it's not going to threaten the receipt of their benefits. So the reason for this bullet is just to let people to think about, or ask people to think about other ways of getting assistive technology into the hands. And then for Northwest Access Fund, this was a way, this program, since it involved financial education, it sort of led to building our, I think, pretty good credit building piece with our financial capability work. And I know that, so Emerson, I'm not hearing anything from you. I'm going to say,
yeah,
Danny.
sorry, mute. Oh, just quickly, Jack, on IDAs, is that what Tracy mentioned earlier about supplemental security income that comes with a max benefit of under 800, I think it's 783. Folks have asset limits where they can't save more than $2,000. Otherwise, their benefits, including Medicaid, potentially will get cut off. And so the IDA really, the biggest part is that we see the value of it is not just in the matching grant, it's the ability to save without risk of losing these crucial benefits that make other aspects of your life work. And then also encourage folks to, if they're eligible, to open up ABLE accounts, which is a great opportunity for some folks with disabilities to be able to save without risk of losing benefits.
Okay, thanks, Emerson. And Danny, I don't know, you thought that Mike might be able to join. He's an advocate within your program for IDAs.
He is. So he was unable to join, but we did have an IDA account. This was probably 7 or 8 years ago, and it was something that we did in collaboration with the United Way of Greater Atlanta. So I wish he were able to make it, but yeah, we did have a very successful, well, it was a successful program, but it was also difficult to get people at the same time because some of the restrictions United Way had put in knocked out some of our potential candidates. But
oh, I see.
we did have, it was a 1-to-5 match, so people were able to get a lot of equipment with that program.
Okay.
Jack, this is Susan.
Yeah, go ahead,
I just wanted to add that we also in Pennsylvania had an IDA program, but could not work through the United Way or through the federal funds because they were restricted on what you could purchase with your IDA, and we wanted to be, you know, tied into our program of assistive technology. So we did outside fundraising from foundations so that we could, while we were doing financial education and some of our pilot programs, we could then have an IDA, and as Emerson said, what's easier now is helping people set up ABLE accounts. And I know we've talked in our trainings about ABLE, but that is a wonderful source of being able to, you know, have people save, but also instruct on the financial education components, and you can also do a match through that ABLE account.
Good. Thanks, Susan. We've got about 10 minutes, so let's open it up. We want to hear from folks about any questions that might have come up in your mind around assistive technology lending. So people can, I think, raise your hands, go on the chat, or Jaleesa can unmute you. So any further questions? Shaban, do you have any further questions at this point?
Right now, I'm just kind of absorbing the information. I think I just heard back from my CEO, and I think like one of his big questions is how we would go about applying for disability funding from CDFIs as a supplemental application if we wanted to do a pilot program. So I think that there is another call coming up about funding streams, right?
There is a community of practice call on fundraising, that's correct.
Yeah.
Okay. Anna, in Iowa, you have an assistive technology lending program. I'm curious about whether you've got any comments on what you've heard so far during this call. Anna may be muted.
Yeah, it doesn't look like Anna has audio, but she says all great information.
I'm sorry, Jaleesa, I didn't hear you. What?
Oh, it doesn't look like Anna actually has audio capabilities, but she said all great information, and she has more questions than answers.
Oh, she has more questions than answers. All right, thanks. And then Natalie in Oklahoma, you also have an AT lending program. I'm just curious if there's anything about the presentation that raised issues in your mind, or you have anything to add about, because you may have some practices that are different than what you've heard today.
No, I don't know that it raised any questions. In terms of practices, I found it interesting to listen to how the decision making was done with all the different entities. Like, because in our scenario, I have the authority within certain debt to income and credit score parameters that I can approve the loans, and then our board of directors meets weekly to be able to review both direct loan request and guarantee loan request. And, you know, we're set up pretty similar to what you guys have talked about in terms of majority of the board of directors is people with disabilities as well.
Uh-huh. Okay. Good, Natalie, thank you. And then Adrian, finally, I want to turn to you because this was the topic that you put down as a priority. I want to make sure that we take this opportunity to address any concerns or issues that you might have as you look to provide assistive technology lending. Adrian, do you have the capacity to speak?
We've actually been, he doesn't have the capacity to speak, it looks like this, David, but we've actually already swapped email information and emails, so hopefully
good.
I can do at least one resource.
Thank you, David. All right, so unless anybody else raises their hand, we can end a little bit early, but of the experts on the line, did we shorten a presentation somewhere that you had another point to make on anything?
No, I guess just for, this is Susan from Pennsylvania. I guess kind of mirroring what we do and what David, who with self-help did, coming from different directions. I think that AT lending can be purposeful in terms of that is what your organization is set up for, or it can be an add-on product from an already existing CDFI. And I think if I heard you correctly, David, that yes, it's a different product line and you were able to kind of stabilize all of the loan terms, so it's one thing and one kind of rate, differing repayment periods, which certainly helps in the administrative. I mean, that's why we have a fixed interest rate, is that the less administrative work we have to do, the better. So I think that people can incorporate AT lending coming from two different directions, and it'll both work for you. But it is a different product because most of the AT devices are unsecured.
All right. Okay. If there's no other comments, we'll end this a few minutes early. Thank you all.
Thank you to everybody.
Thank you. Have a great one.
Yeah.
Okay. Bye-bye.